Welcome to the Deep Dive, where we cut through the noise, we deliver the insights you need. And hey, if you find this valuable, do us a favor. Like and subscribe to Stock Analytics AI on YouTube, our 4.99-month members. They get priority deep dives on specific tickers. Just saying. Today, we are plunging into Circle Internet Group, Inc., NYSE ticker CRCL, fresh off its Wall Street debut. Everyone's talking about this one. So the big question we're tackling is this. Is Circle really like the AWS of stablecoins, building the essential plumbing for this whole new internet of value? Or is this massive valuation just, speculative hike that's going to crash and burn?
Yeah, and our mission today is to look past that initial kind of crazy IPO pop. We're applying a really disciplined fundamental lens here. We want to understand the business, the leadership, the financials, and crucially, the huge risks and opportunities. As of June 17th, 2025, the stock closed at $151.06. So we're going to dig into what that price actually means.
And here's a little sneak peek for you. What we found, let's just say there seems to be a pretty profound disconnect between how the market values Circle right now and what we estimate its intrinsic value might be. We're going to break this down methodically. Two main parts. First up, the core business, the management team, financial health, all that good stuff. Then we'll shift focus. We'll look at market sentiment, who owns the stock, the risks, and then, pull it all together in the conclusion. All right, let's kick things off. Chapter 1, business analysis. Okay, let's unpack this. What exactly is Circle? Lots of people know the name USDC, but maybe not the nuts and bolts.
Right, so at its core, Circle is the main operator and issuer of USD coin, USDC, that's the big stable coin, paid 1-to-1 to the US dollar. And the key thing, as you hinted, is it's backed by actual cash and short-term US Treasury bills, fully reserved.
Okay, so that's the stable part. How do they actually make money then? Is it fees or?
Well, this is where it gets fascinating and maybe counterintuitive for a tech company. Their main moneymaker isn't transaction fees. It's the interest income they earn on those massive reserves backing USDC. Just look at Q1 2025. They pulled in, $578.6 million in total revenue? $557.9 million of that, the vast majority was interest income.
Wow. So their profitability is really tied to two big things then.
Exactly. How much USDC is out there circulating, and crucially, what are the prevailing interest rates? It makes them highly sensitive to the macro environment, almost like a Fintech bond fund in some ways.
Interesting. Okay, so besides just issuing USDC, what else are they building? You mentioned plumbing.
They're definitely building more. Beyond USDC and EURC, their Euro stablecoin, they have the Circle platform. Think of it as a set of APIs, tools for businesses to easily plug digital currency, payments, payouts, accounts right into their systems.
And what about moving USDC around, different blockchains and all that?
Yeah, that's where their cross-chain transfer protocol, or CCTP, comes in. And this is critical. It's not just a basic bridge. It lets USDC move natively and securely between different blockchains. Think Ethereum, Solana, the XRP ledger, loads of them. And the volume shows its importance. It hit a record $7.7 billion transferred just in May 2025. That's huge for, making USDC actually usable across the crypto space.
Okay, so clearly a major player. Where do they sit in the overall stablecoin market right now?
They're number 2. USDC is the world's second largest stablecoin, market cap around $61 billion. That gives them roughly, say, 25-27% market share, which is significant. And they've settled trillions, literally trillions of dollars in on-chain transactions, massive scale.
And the whole market is growing, right?
Exploding.
Yeah.
The stablecoin market is already over $200 billion in 2025, and projections. Citigroup, for example, thinks it could reach up to $3.7 trillion by 2030.
3.7 trillion.
Trillion, yeah. And it's not just crypto D-engines anymore. We're seeing accelerating institutional adoption. BlackRock, BNY Mellon, Visa, Shopify. They're all integrating stablecoins, often USDC.
So with that potential, how does Circle stand out, especially against Tether, USDT, which is still bigger?
Their whole value proposition, their differentiator, is built around being regulated, transparent, and trusted. That's the mantra. They've very deliberately gone for a compliance-first approach. Regular audits, working with regulators. It's a stark contrast to Tether, which, let's be honest, has faced a lot of questions over the years about its reserves and transparency. Circle uses that as a competitive advantage.
So it's really a two-horse race then, Circle versus Tether, or are there others we need to watch?
It's largely a duopoly right now, yeah. Tether's USDT is significantly larger, over $150 billion market cap, compared to USDC's $61 billion. Yeah. And Circle's strategy is basically, like I said, be the anti-Tether, the clean, regulated option. But new competition is emerging. PayPal launched its own stablecoin, PYUSD. That's a big name. And then there's the sort of long-term elephant in the room. Central bank digital currencies, CBDCs. If governments launch their own digital dollars or euros, well, that changes the game entirely.
Right. And you mentioned regulation being critical. What's happening on that front? Is it helping or hurting Circle?
It's probably the single most important external factor. Right now, things look potentially favorable for Circle. There's legislation moving through the U.S. Congress, the Genius Act, quite the name, guiding and establishing national innovation for U.S. stablecoins. If that passes, it would create a clear federal rulebook. Things like mandating transparency, audits, reserve requirements, essentially codifying Circle's existing model.
So regulation could actually strengthen their position.
Potentially, yes. It favors their compliance-first approach. They're also already complying with international rules, like the EU's MiCA regulation. It helps build that regulatory moat we talked about.
Okay, so what are those barriers to entry then? Why can't someone just launch another stablecoin tomorrow and compete?
Well, you can, but it's incredibly hard to succeed at scale. First, there's the regulatory nightmare. Getting licenses in all the jurisdictions you need. Hugely expensive and complex. Then, building trust. That's paramount. Circle achieved this through transparency, audits by firms like Deloitte, and partnerships with giants like BNY Mellon for reserve custody. That takes years. And finally, network effects. Liquidity. USDC is integrated everywhere. Exchanges, DeFi protocols, payment platforms. For a new coin to get that kind of acceptance, it's a massive uphill battle.
So, summing up their advantages.
Okay, key advantages. Strong brand USDC is seen as the institutional stablecoin. Economies of scale in managing those huge reserves. Powerful network effects, the more people use it, the more useful it becomes. And that regulatory moat, things like the New York BIT license, their EU e-money license, plus those deep partnerships with BlackRock, BNY Mellon, Coinbase, it all adds up to a really strong competitive position.
All right, that sets the stage nicely for the business. Let's pivot now, Chapter 2. Management evaluation. Because let's face it, in a space this volatile, leadership is absolutely critical. Who's actually running Circle?
The man on the top is co-founder and CEO Jeremy Allaire. He's not new to this game. He's a serial entrepreneur, and importantly, he has experience taking companies public. He did it with Allaire Corporation back in the day and also Brightcove. That experience navigating public markets, investor relations, it's a significant plus for a company like Circle making its debut.
And leadership isn't just about smooth sailing, right? It's about crises. The Silicon Valley Bank collapse in March 2023, that must have been a huge test.
Oh, it was a massive test.
Yeah.
A real crucible moment. Remember, Circle suddenly revealed they had $3.3 billion billion, with the B of USDC reserves stuck at SVB when it collapsed. USDC immediately depegged, dropping to like 87 cents. Panic set in. It could have been an existential threat.
How did Allaire handle it?
A textbook crisis management, really. He was extremely transparent, providing constant updates. He stated unequivocally Circle would cover any shortfall from corporate funds if needed. And they moved incredibly fast to set up new banking relationships. Within days, the peg was fully restored. Paradoxically, while terrifying at the time, successfully navigating that crisis actually enhanced USDC's reputation for resilience. It proved the model and the management could withstand a major shock. I remember watching it live. It was tense.
Impress. Who else is on the executive team? Anyone notable?
Yeah, the broader team is strong, too. They've got a good mix of traditional finance and tech chops. Heath Tarbert is president. He's the former chairman of the CFTC, the U.S. commodities regulator. That's serious regulatory credibility. And the CFO is Jeremy Fox-Geen. He was previously CFO for McKinsey & Company in North America. Again, strong traditional finance background.
And communication-wise, you mentioned transparency during the SVB crisis. Is that typical?
Generally, yes. Transparency is kind of core to their brand, right? Allaire is very active publicly, advocating for stablecoin legislation in D.C. They publish regular reserve attestations, auditor reports, trying to be the good guys. Although, it's worth mentioning there was some public criticism right after the IPO. A crypto investment firm called Arca complained pretty loudly.
Oh, about what?
They argued the IPO share allocation wasn't fair, that it favored the big Wall Street institutions over the crypto-native firms that helped build the USDC network in the first place.
Yeah.
So a bit of tension there between TradFi and crypto roots.
Interesting dynamic. Okay, let's talk capital allocation. Where are they putting their money? Any big acquisitions or sales?
Their strategy seems pretty focused. The priority is clearly reinvesting in the core platform, expanding USDC's reach and utility. If you look at their M&A history, it tells a story. Back in 2018, they bought the crypto exchange Poloniex. That seems like diversification, but then they sold it off in 2020. That signaled a real pivot back to focusing squarely on the USDC ecosystem. More recently, like the Hashnode acquisition in 2025, it's about deepening that core offering, adding capabilities.
Didn't Ripple try to buy them?
They did. Reportedly offered $5 billion in 2025. Circle turned it down. That shows confidence in their standalone path. And in terms of shareholder returns, look, they're a high-growth company, just went public, focuses on reinvestment. So no dividends currently, none expected soon, no history of share buybacks either.
Got it. Now, one key metric investors love is return on invested capital, ROIC. Our sources mention something odd, like negative invested capital. How does that work for Circle?
Yeah, that's a really important point, and it highlights how unique their model is. A standard ROIC calculation can be super misleading for Circle. Because they hold so much cash and equivalents as reserves against USDC, those assets often exceed their traditional debt and equity. That can mathematically lead to negative invested capital, which sounds weird.
So the metric is useless.
Not entirely, but you need to interpret it differently. If you look at normalized ROIC figures trying to adjust for this, they often come out above 20%. What that really suggests is that this is a highly capital-light business model, despite the huge balance sheet. They can generate substantial profits without needing massive amounts of traditional capital investment. That's actually a big strength.
Okay, makes sense. Let's dive into the numbers more deeply then. Chapter 3, Financial Analysis. Give us the snapshot again. Key metrics as of mid-June 2025.
Right. Share price hovering around $151. Market cap, roughly $33.3 billion. Now, the valuation metrics are where eyebrows get raised. Price to earnings, PE ratio, well over 200. Some sources even put it over 1,000, depending on how you calculate trailing earnings.
Whoa. Compared to
peers like Coinbase, maybe around 45 PE,
Mhm.
Block, maybe 15-30, PayPal, around 16. So Circle is trading at a massive premium. Price to sales ratio is also high, around 17.6. On the stability side, though, things look solid. Debt to equity is tiny, 0.03. They're barely levered. Current ratio is 1.02, which we'll come back to.
Let's talk revenue first. How has that been growing?
Explosive, but also volatile, which makes sense given the interest rate dependency. It went from $772 million in 2022 up to $1.45 billion in 2023. That's 88% growth. Then $1.68 billion in 2024, about 16% growth. And Q1 2025 was strong, $578.6 million, up 59% year over year. But again, heavily tied to the macro environment, especially rates.
And profitability. You mentioned they lost money in 2022.
Yeah, big turnaround there. They posted a net loss of nearly $770 million in 2022, but they swung to sustained profitability in 2023 and 2024. Looking at the trailing 12 months, TTM, margins are actually pretty healthy. Gross margin around 24%, operating margin 11%, net margin 9.1%. And that's after paying out significant amounts, like the revenue share deal with Coinbase and covering those high compliance costs.
What about cash flow? Are they actually generating cash?
Yes, strongly. Free cash flow was $140 million in 2023, jumped to $345 million in 2024. And for the TTM, $300.3 million. So the profitable growth is translating into real cash.
Okay, back to financial stability. That balance sheet, you said it's unique. How should we think about that 1.002 current ratio? Normally that might look a bit tight.
Right, context is everything here. For a normal company, 1.02 might signal liquidity issues. But Circle's balance sheet is different. Their main liability is USDC in circulation. Their main asset is the reserves backing that USDC highly liquid cash and short-term treasuries. They're designed to match. So the current ratio being close to 1 isn't inherently worrying. The real measure of liquidity is the quality and accessibility of those reserve assets. Can they meet redemption demands instantly? So far, the answer has been yes, even during stress like SVB. And yeah, that debt to equity of 0.03 just reinforces they have very little traditional debt risk, no dividends, as we mentioned.
Okay, so financially stable, profitable now, growing fast. But that valuation, valuing this company seems like the $1 million or maybe $33 billion question.
It's incredibly challenging, absolutely, because the current price isn't based on current earnings or cash flows. It's pricing in enormous future potential, almost like a venture capital bet.
So how do we even attempt to find an intrinsic value? What tools can we use?
The standard tool is a discounted cash flow analysis, a DCF. You try to project the company's future free cash flows, say 10 years out. Then you estimate a terminal value and discount all that back to today's value using an appropriate discount rate. But, and this is a huge but for Circle, any DCF model right now is highly speculative. The inputs are subject to massive uncertainty. What will interest rates do? How fast will USDC really grow? What regulations will pass? How much competition will emerge?
Okay, understood. Heavy caveats. But running an educational DCF model, what kind of value range did it spit out?
Even being quite aggressive with the growth assumptions, our educational model suggests an intrinsic value for Circle, somewhere in the range of $50 to $90 per share.
$50 to $90
And
compared to the market price of 151 Tubbers. That's a big gap.
a very big gap.
What were the key assumptions you had to make to even get to that $50 to $90 range?
We use a 10-year forecast period, which is standard for growth companies. We had to assume really aggressive revenue growth, think 35% to 45% per year for the first 5 years, then tapering off. We used a terminal growth rate of 3.0%, basically assuming they grow slightly faster than the long-term economy forever after year 10. And crucially, we used an 11.0% discount rate, or WACC, weighted average cost of capital. That's quite high, reflecting the significant risks involved in the business and the uncertainty.
And even with those pretty optimistic growth assumptions, you still land way below the current market price.
Exactly. It reinforces the idea that the current $151 price isn't really anchored to traditional fundamental valuation based on projected cash flows. It's driven by something else.
Okay, let's shift gears then into part 2 of our analysis. Let's start with Chapter 4, Market Sentiment. What strikes you about how the market feels about Circle right now? What's the vibe?
Well, the first thing is there's kind of an information vacuum from the traditional sources because it only IPO'd on June 5th, 2025. As of mid-June, none of the major investment banks have put out official analyst ratings or price targets yet. That usually takes a few weeks, post-quiet period.
So no Wall Street consensus yet. What are people saying informally?
Online forums, social media,
Yeah.
you see some really wild speculative targets, up to $300 a share, things like that. That's pure initial euphoria, driven by the huge IPO pop. The general media tone has also been overwhelmingly positive. Headlines using words like blockbuster, historic, explosive debut. They focus on that 168% first-day surge and the strong institutional demand.
But is anyone sounding a note of caution?
Yes, if you dig into more detailed financial commentary, you definitely find more cautious undertones. People raising concerns about, well, the extreme valuation we just discussed, the risk of interest rates falling, potential insider selling down the line.
Yeah.
The usual worries, but amplified given the price.
And technically, any chart patterns or indicators for traders?
It's just too early. A stock this new simply doesn't have meaningful technical indicators. No real short interest data yet, no moving averages established, nothing reliable for technical analysis.
So what's driving the price day to day then?
Right now, it seems to be almost purely narrative, sentiment, and short-term supply and demand dynamics from the IPO itself. Who got shares, who wants shares, the story around the company. That's what's moving the needle, which naturally leads to higher volatility. It's more emotion-driven than data-driven at this stage.
Okay, narrative is key. Let's look at who actually holds that narrative and the shares. Chapter 5, ownership structure. Who are the big owners of Circle? Any major institutions jumping in?
Definitely significant institutional interest. BlackRock reportedly planned to take a 10% stake, which is huge validation. And Cathie Wood's ARK Investment Management was a big buyer right at the IPO. They bought around $373 million worth of shares across 3 of their ETFs, ARKK, ARKW, ARKF. Japan's SBI Holdings also put in $50 million. So yes, some major players are placing bets.
But wasn't there some controversy about the allocation? You mentioned ARCA earlier.
Right. That crypto investment firm, Arca, they publicly criticized the process. They felt the IPO allocation unfairly favored the traditional Wall Street firms, the big banks and funds, over the crypto-native VCs and firms that had supported Circle and USDC for years. It highlighted the potential friction between the crypto world and the traditional finance world Circle is trying to bridge.
Interesting. Can you give us a rough breakdown of who owns what category-wise, and what about insiders?
Sure. Based on filings around the IPO, it looks roughly like this. Venture capital and private equity investors from before the IPO hold about 30.7%. Other institutional investors, like the ARKs and BlackRocks, hold around 10.1%. The general public accounts for a large chunk, 52.1%. That's mostly retail investors buying post-IPO. Individual insiders themselves own about 0.3% directly, and private companies hold around 6.8%.
Only 0.3% for insiders. That seems low.
Well, that's direct holdings of the publicly traded shares. The key thing for control is the voting power. Co-founders Jeremy Allaire and Sean Neville together retain about 30% of the total voting power through special Class B supervoting shares. So they still have significant strategic control despite the low direct ownership percentage.
Have any insiders been selling since the IPO?
Yes, there were filings showing some sales by CEO Allaire, CFO Fox Jean, and President Tarbert shortly after the IPO. Now, this often happens post-IPO. Executives need liquidity, they have tax bills from vesting stock. It doesn't necessarily mean they've lost faith, they still hold very significant stakes, but it's something the market always watches.
So what are the implications of this ownership structure? Lots of VC and founder control.
Yeah, the ownership is pretty concentrated among founders, early VC SPE, and now these large institutions. On one hand, that can provide stability. These are likely long-term holders. But the risk, especially for those early investors, is the lockup expiration. Typically, 180 days after the IPO, they're allowed to sell their shares. If a lot of them decide to cash out some of their gains then, it could flood the market with supply and put downward pressure on the stock price.
Yeah.
That's a date many investors will have circled on their calendars.
Definitely something to watch. Okay, let's synthesize the potential downsides. Chapter 6, risk assessment. Let's use a classic SWOT framework. What are Circle's biggest strengths and weaknesses?
Strengths are pretty clear by now, I think.
Huh.
That regulatory-first approach, building trust, the strong USDC brand, deep partnerships with both crypto and traditional players, experienced management team, and those powerful network effects. Weaknesses. The big one is that revenue sensitivity to interest rates. Huge dependency there. Reliance on key partners, like that Coinbase revenue sharing deal. What if that changes? High operating costs due to compliance. And just being a newly public company, limited track record in managing public market expectations.
Okay, and flipping that coin, opportunities and threats.
Opportunities are massive. That projected growth in the stablecoin market, trillions potentially. Favorable stablecoin legislation like the Genius Act would be a huge tailwind, potentially locking in their advantage. Expanding their high-margin enterprise software business, and just broader adoption of USDC in mainstream commerce and payments. Threats. Intense competition. Tether isn't going away. PayPal is getting serious. Other banks or fintechs could jump in. The ever-present threat of CBDCs becoming the dominant digital currency. Systemic risk, another crypto meltdown, or even a traditional banking crisis could hurt USDC demand. Unfavorable regulatory changes are always possible, and broader geopolitical or macroeconomic shocks.
Let's dig into those macro threats. You've hammered home the interest rate risk. Is that the single biggest threat?
From a purely business model perspective right now, yes, arguably. A significant sustained drop in interest rates by the Federal Reserve would directly hit their primary revenue stream, hard. Unless they can rapidly scale up other revenue sources like their platform fees, a low-rate environment really compresses their earnings potential. So investing in Circle today is in large part an implicit bet that rates will stay elevated or that these new revenue streams will grow very, very quickly.
What about geopolitics? You mentioned the 2025 U.S.-China tariff war in the notes. How does something like that impact Circle? They're not shipping goods.
No, it's indirect but potentially significant. Major geopolitical tensions, like a trade war, create broad market uncertainty and volatility. Often this triggers a risk-off sentiment in markets. Investors get nervous, they pull back from assets they perceive as risky. And right now, rightly or wrongly, cryptocurrencies and related assets are often seen as high risk. So a risk-off environment could lead to a crypto bear market, reducing trading activity, reducing demand for stablecoins like USDC for settlement and collateral.
Which shrinks the reserves Circle earns interest on.
Exactly, it hits their core engine. So while sometimes crypto is pitched as a safe haven, major geopolitical or economic shocks often hurt the whole digital asset ecosystem in the short to medium term. Circle isn't immune to that broader sentiment.
All right, we've covered a lot of ground. Let's try to bring it all together. Chapter 7, conclusion. So, after this deep dive, what does it all mean for Circle and potential investors?
Well, let's lay out the bull case first. It's compelling. Circle is strategically positioned as potentially essential financial infrastructure for the digital age. The regulated picks and shovels for the crypto economy. They have a strong moat built on regulatory trust, transparency, key partnerships. That moat should theoretically widen as the industry matures and regulation solidifies. They've got proven management, they're profitable, generating cash, in a market projected to be enormous. That's the bull story.
Okay, sounds great. Now the bear case.
The bear case is equally forceful, frankly. It starts and ends with that astronomical valuation. $151 a share, PE over 200. It's completely detached from current fundamentals, leaves zero room for error, zero margin of safety. The business model itself is fundamentally vulnerable to falling interest rates. Competition is intense and growing, from Tether, from TradFi players like PayPal, and potentially from CBDCs down the line. And the entire thesis really hinges on favorable regulation passing and benefiting Circle specifically. That's a big bet on political outcomes.
And remind us that DCF range, even with optimistic assumptions.
Our educational DCF model, highly speculative as it is, suggested an intrinsic value between $50 and $90 per share.
So the concluding outlook, how do we square the $151 market price with that $50-$90 estimate?
Our analysis points to a significant disconnect. The current market price of $151.06 is substantially above our estimated intrinsic value range. This isn't the stock you buy based on traditional value metrics today. Investing in CRCL at this price is a high-risk, potentially high-reward venture bet on the future, playing out exactly as the bulls hope. It's a bet that Circle becomes that foundational, almost monopolistic infrastructure for a new internet of value, and that its growth will be so transformative that it justifies today's price tag, which current fundamentals simply don't. The investment case rests almost entirely on that narrative.
So here's a final thought for you to ponder. Given that valuation, is investing in Circle less about buying a stock based on its current merits and maybe more about betting on the very future of money itself? If you found this deep dive valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel. More in-depth analysis is coming, and our members get priority access.
And the important disclaimer, this analysis was generated by an AI system for educational purposes only. It should not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.